The London headquartered Vedanta Resources Limited, the parent company of Mumbai-listed mining giant Vedanta Limited, has been trying to assuage investors of its debt burden for a while now. Its debt burden, which came under scanner after the Adani Hindenburg turmoil, seems to be easing now after it paid off all the mature debt of the April month. As on April 2023, Vedanta's debt stands at $6.8 billion, down from $9.7 billion in March last year. The promoters of Vedanta also got 70,444 crore rupees worth of pledged shares released. This is being touted as one of the largest releases in the listed space. According to Group Head Anil Agarwal, the company is well positioned to meet its debt obligations and the concern around being over-leveraged is misplaced. Agarwal has said that the group is expected to make a profit of $9 billion next year on its revenue of $30 billion. The Adani Group, on the other hand, has secured assurances of financial support from three Japanese banks, Mitsubishi UFJ Financial Group, Sumitomo Mitsui Banking, and Mizuho Financial Group. The support will aid the group's expansion plans and help refinance and restructure debts. The existing lenders, Standard Chartered and Barclays, have expressed confidence in the group as well. Adani Power's consolidated net profit after tax for Q4 FY23 rose 12.9% to Rs 5,242 crore as compared to Rs 4,645 crore for Q4 FY22. Adani Ports and Special Economic Zone has contributed an impressive 80,732 crore rupees to the coffers of the Customs Department in FY23. This was an increase from 60,945 crore rupees in FY22. The mentioned increase is a result of increased cargo handling capacity at the port. The port company handled 339 million tons of cargo in FY23, which was an increase of 8.6% year-on-year. Do these developments suggest that Adani and Vedanta have turned the corner?
So let us first take Adani issue. The Hindenburg report, when it came out, actually, in my opinion, it was a very big shock to overall Indian capital markets, including Adani in particular. But the way Gautam Adani faced the challenges, he has demonstrated his leadership. He prepaid certain debts. However, because of the capital intensive nature of his industry, challenges remain. He will have to raise the funds again. So we cannot say turnaround, but we can say damage control has been done very well. Now, second thing is Vedanta, and size is a little smaller compared to Adani, but they have also repaid $1 billion now, prepaid. But prepaid doesn't mean that they don't need the funds. And looking into the confidence of Mr. Anil Agrawal, again, management quality matters. So in the past many years, he has proved himself to be a good leader coming out of the difficult situations very well. So industry, especially financiers, trusts the leader. But turnaround in his case too has not happened right now.
Both Vedanta and Adani are heavily invested in capital-intensive sectors. Adani Group's debt rose almost 21% over the past year, whereas Vedanta had accumulated debts of $9.7 billion. But over the past year, both the groups have taken many steps to pay down their debts. Looking at the stock prices, both Vedanta and Adani Group stocks have corrected significantly. Investors can take some time to relook at the finances of these companies before confidence re-emerges.
The London headquartered Vedanta Resources Limited has ambitious plans to set up a $19 billion chip manufacturing plant in Gujarat. This is in partnership with Taiwan's Honhai Precision Industry. However, the joint venture has not yet been finalized because of some compliance holdups. Vedanta is yet to disclose its tech partner for the high-precision nanotechnology for chip manufacturing. Not to mention, the company has no prior experience in chip manufacturing as well. Inadequate disclosures might make it difficult for Vedanta to secure 50% funding from the government. The Adani Group, meanwhile, had completed the sale of its Myanmar port business for $30 million following sanctions from the US. The sale dealt a $120 million blow to the group's port business. On top of this, the group is still recovering from the $100 billion loss in market value following the Hindenburg report. What, then, are the challenges faced by the Vedanta and Adani?
Challenges that remain for the groups is more towards bringing the net debt to EBITDA ratio and the debt service coverage ratio within acceptable limits. To do this, the groups would navigate the next few quarters in a way where the capex is generally tapered and cash flows that are generated by the businesses are used towards paying down the debt. Furthermore, they would look to really show the robustness of the underlying businesses by way of superlative quarterly growth in earnings, which would not only help in servicing the debt and achieving a positive and favorable debt service coverage ratio, but it would also help in paring down the net debt at the group level.
While the companies are performing relatively better, experts are skeptical if Adani and Vedanta have completely turned the corner. According to reports, the government is likely to oppose any plan by Hindustan Zinc Limited to buy out parent Vedanta's global zinc business even via a non-cash deal unless the valuation of the assets is brought down to a more realistic level. The Adani Group, on the other hand, has still not recovered its lost market value.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.